How to protect your money in 2026 Risk Management Rule. Market Protection Tip. Money is changing faster than most people realize. What worked 5 years ago will not protect you in 2026. Inflation is no longer temporary and interest. Rates are no longer predictable. Markets are more emotional, more connected, and more fragile than ever before. If you do not change how you protect your money, you will slowly lose purchasing power without noticing it. This is not about fear. This is about preparation. In 2026, the biggest risk is not losing money quickly. The biggest risk is losing money slowly. Prices rise quietly, taxes increase silently, and fees drain accounts invisibly. Most people only realize the damage when it is too late. This guide is about protection, not speculation. It is about defense before offense and surviving any market environment. The first rule of money is simple. You cannot grow what you cannot protect. Risk management is more important than returns. People love talking about how much money they can make, but very few talk about how much money they can keep. In unstable economic periods, survival beats performance. A portfolio that grows slowly but survives wins over time, while a portfolio that grows fast but collapses once loses everything. The risk management rule for 2026 is diversification across risk types, not just assets. Most people think diversification means buying different stocks, but that thinking is outdated. True diversification means spreading your money across different economic outcomes. Ask yourself, what happens if inflation stays high? What happens if inflation drops fast? What happens if interest rates stay high? What happens if interest rates fall suddenly? What happens if markets crash? And what happens if markets go sideways for years? Your money should not depend on only one answer. In 2026, markets will react strongly to news, data, and policy changes, which means volatility will remain high. Volatility is not bad if you are prepared, but it is dangerous if you are exposed. The first protection move is reducing unnecessary exposure. If you do not clearly understand an investment, it is already a risk. Complex products hide risk behind fancy language. If someone cannot explain an investment in simple words, you should walk away. The second protection move is liquidity. Liquidity means access to your money when you need it. In 2026, liquidity is power. Many people lock money into long-term assets without thinking, and when emergencies happen, they are forced to sell at the worst time. You should always have accessible funds, including cash equivalents and short-term instruments. Liquidity gives you options, and options reduce stress. Cash is not useless in uncertain times. Cash is insurance. However, holding too much cash has a cost because inflation slowly eats its value. That is why balance matters. The goal is not to avoid risk completely. The goal is to control risk. One of the biggest threats in 2026 is persistent inflation. Inflation may not return to old levels for many years, and even moderate inflation destroys long-term savings. If inflation averages 4%, your money loses about half its value in less than 20 years. Doing nothing is still a decision, and it is usually a bad one. To protect against inflation, your money needs exposure to assets that can adjust prices over time. Businesses with pricing power survive inflation better, and real assets tend to hold value better than fixed income alone. But concentration is dangerous. Never rely on only one inflation hedge. Protection works best in layers. The first layer is income stability. Your primary income source must be resilient. In 2026, job security depends on skills, not titles. If your income depends on one fragile industry, your finances are at risk. Income diversification is part of money protection, and it does not mean working nonstop. It means having backup options. The second layer is expense control. Inflation hurts people with fixed spending habits the most. People who do not adjust expenses feel inflation more painfully. Tracking expenses is no longer optional. Small leaks sink big ships, and subscriptions fees and lifestyle inflation quietly destroy wealth. Protection starts with awareness. The third layer is tax efficiency. Taxes are one of the largest guaranteed expenses in life. In 2026, tax rules will continue to change, and ignoring taxes means ignoring reality. Protecting money means keeping more of what you earn legally. This is not about avoiding taxes illegally, it is about planning correctly. Tax-advantaged accounts exist for a reason and should be used properly. Understanding how income taxes, capital gains, and deductions affect your final outcome is critical. A higher return with higher taxes can leave you with less money than a lower taxed alternative. Protection is about net results, not headline returns. Now let us talk about market protection. Markets in 2026 will be driven by central bank policy, government debt, and investor psychology. These forces create sudden shifts, and the biggest mistake investors make is reacting emotionally. Fear causes people to sell at the bottom, and greed causes people to buy at the top. Market protection means removing emotion from decisions. Rules protect you from yourself. Every investor should have written rules for buying, selling, and risk limits. If you do not define rules during calm times, emotions will define them during stressful times. One powerful rule is position sizing. Never risk too much on one idea because even the best investors are wrong often. Limiting downside keeps you in the game. Another important rule is avoiding leverage unless it is fully understood. Leverage magnifies mistakes, and in volatile markets, small errors turn into disasters. Debt is not always bad, but unmanaged debt is dangerous. In 2026, rising interest rates make debt more expensive. High-interest debt, especially credit cards, must be controlled or eliminated because paying high interest is the opposite of investing. Long-term investing and short-term speculation are not the same thing. Long-term investing builds wealth slowly, while speculation creates stress. Protection means knowing the difference. Money needed soon should not be exposed to large market swings. Time horizon determines risk tolerance and mixing time. Horizons creates forced mistakes. Information overload is another hidden risk. Too much financial news leads to poor decisions because markets move on narratives, not facts alone. Protect your mind by limiting exposure to noise and focusing on fundamentals. Ask simple questions like, is the business profitable? Is the balance sheet strong? And is the valuation reasonable? Complex stories often hide weak foundations. Retirement protection is also critical. Retirement is not an age, it is a financial condition. In 2026, planning must account for longer lifespans. Running out of money is the biggest risk. That means planning for income, not just savings. Reliable income streams reduce anxiety, and sequence risk must be managed. Because large losses early in retirement are especially dangerous. Behavior determines financial outcomes more than intelligence. Consistency beats brilliance, and protecting money means avoiding big mistakes like panic selling trend. Chasing, ignoring fees, and overconfidence. Fees matter more than most people realize because small percentages compound into large losses over time. Always know what you are paying and why, because transparent costs protect wealth while hidden costs destroy it. Insurance is another overlooked protection tool. Insurance transfers risks you cannot afford to keep, such as health accidents and liability. Ignoring insurance is gambling with your future. Protection may be boring, but boring works. Global exposure matters because markets are interconnected. Events in one country affect others, and overconcentration in one region increases risk. Global diversification spreads exposure, but it must be intentional, and currency risk must be understood. Holding everything in one currency concentrates risk. Technology and fraud risks are also growing. Digital finance makes life easier, but scams are becoming more advanced. Protecting money in 2026 means protecting your data. Strong passwords and two-factor authentication are essential. Never rush financial decisions online because urgency is a common scam tactic. Always verify before acting. Protection is proactive. Waiting for perfect clarity usually means waiting too long. Perfect certainty does not exist in markets. Preparedness beats prediction. Focus on what you can control, such as spending, saving risk, exposure, and behavior. You cannot control markets, but you can control your response. The goal is resilience. Resilient systems survive shocks. Your finances should be flexible and adaptable. Avoid locking everything into one rigid plan and review your strategy regularly. Static plans fail in dynamic environments. To summarize the protection framework for 2026, prioritize risk management over returns. Diversify across economic outcomes. Maintain liquidity. Protect against inflation thoughtfully. Manage taxes intentionally. Control behavior with rules. Reduce unnecessary debt. Plan income, not just growth. Protect against fraud and stay adaptable. Money protection is not a one-time action, it is an ongoing process. Small improvements compound over time while ignoring protection compounds losses. In 2026, the winners will not be the biggest risk takers, but the most disciplined planners. They will survive volatility, stay calm when others panic, sleep better at night, and quietly build lasting wealth. Protect your money first, growth comes second. And that is how you win in 2026 and beyond. Thank you for your support, and have a nice day.